I love the idea of the fund that holds the most spot Bitcoin at the end of the cycle is the winner. I love that. I think you need to see the wirehouses put Bitcoin into model portfolios to really have the ETFs blow up. And as you know, BlackRock's got them in a couple model portfolios. And I think you're going to see that. If we're just talking about straight up institutional adoption, still most advisors can't or won't put their customers into Bitcoin. And it's, you know, it's a legitimate, very large ETF asset class, let alone the market itself. So that is coming. That is finally coming. And that is going to change. Then you start having permanent passive bids on Bitcoin, right? Like people who, as the, you know, need to rebalance in and, by the way, and out, that lowers volatility and makes it a lot more like, honestly, like an equity-like investment or an index investment.
And so that's pretty contentious in the Bitcoin community, this idea of Bitcoin DeFi. Generally just, you know, not buying and holding your BTC, but potentially staking it elsewhere and putting it at risk for what are, at the moment, relatively light yields. So what has developed in Bitcoin yield land? We'll keep it pretty high level for the purposes of this conversation, but obviously you have firms like Cantor Fitzgerald just announced they're doing Bitcoin-based lending, but you have obviously some forms of DeFi. You could say most of it was a huge Bitcoin run, Q1, Q2 last year, where a ton of Bitcoin DeFi-related protocols were funded at huge valuations, but most of them look like their own L1s with a bridge to Bitcoin. So I guess are there any, you know, I don't know, strong views for or against Bitcoin lending, both centralized or decentralized?
So I have a pretty strong take on this as a creditor to several estates of last cycle. I think there's this natural tendency in Bitcoin to want to earn yield like you would with any other asset. And historically, the only option you've had is to take some sort of counterparty risk, right? And you've gone to BlockFi, Genesis, Celsius, et cetera, last cycle, and we all saw how that wound up. Now there's some new spokes popping up, and it's usually a good like start to sell everything when centralized lending gets really popular in crypto again. Like it's just a general good top signal. But now with the advent of Bitcoin staking, where you can actually take no principal risk, right? So what you can do is just use Bitcoin itself to earn passive yield. That's going to set a new benchmark for the galaxies of the world, et cetera, that now they have to go out there and beat that rate and need to have the right assurances behind that offering, right? And whether it's like a personal balance sheet from one of the founders of one of these places that gets in front of it, or whatever needs to happen to ensure that there is, you know, risk minimized on this lending side, I think it's just making sure that there is proper compensation. But we shouldn't kid ourselves that like as soon as Wall Street really gets its hooked into Bitcoin, there's going to be rehypothecation everywhere. Right? Like that's just how this is all going to work. And it's going to be what sort of guarantees can you get and ultimately what yield can you get. But it's a part of the system and we all have to live with it.
And that's why since 2016, I've been predicting that Bitcoin will cause a blow up at a GSIB because it is not the same asset as traditional financial assets. And ultimately, the biggest difference is not just the scarcity of Bitcoin, it's the fact that the vast majority of it is in the hands of long-term hodlers, and we're not letting go. And there is no lender of last resort, therefore, and to the extent that you start to see the GSIBs do the same things that they do with other asset classes, like commingling in collateral pools and allowing collateral substitution, the prime brokerage units are going to find themselves short, and they're not even going to be aware of it if they don't segregate. And that's what's going to blow somebody up someday.
Okay, I'm going to do a quick poll. Who here owns Bitcoin? Okay, keep your hand up if you own Bitcoin in your self-custody wallet, not via ETF. Okay, so it's probably about a quarter of the people that own Bitcoin own it outright. Is that a risk? So listen, I love capital flows, and I think the ETFs have been fantastic for the price of Bitcoin. I've always felt concerned that it's created a potential risk for what Bitcoin stands for a lot of at least the early hodlers, and also just generally for consensus, you know, for network upgrades and a lot of the potential changes to the protocol in the future that is driven by a few superpowers of the financial community. Anyone have a very contentious view on ETFs, you know, positively or negatively?
It's a double-edged sword, and one of the biggest challenges with the ETFs, one of the black swan events that could really disrupt is if the North Koreans get the custodian, the ETF custodian hacked. That would just be a disaster.
So I'll take I don't know how contentious it is, but like for most people in the audience, maybe you're aware that Bitcoin has these halving cycles that puts a lot of pressure on the miners. We're like 4 to 8 years away from that being a real problem in Bitcoin, probably, unless we can get a lot more volume on the network. And I think there's actually an end state where these ETFs are really the miners of last resort, where they're the only ones that can actually run at a loss to actually keep their products open because they're making money off these fees. And I think that's actually a very large risk to Bitcoin because I think that miner economics are pretty inverted. We had a win right before this panel where putting your Bitcoin or mining with Bitcoin mining pools is actually not a security, which is a big win. But I think in general, like these are the kind of, I wouldn't call it a black swan, but these are like some of the big risks that we have with centralizing Bitcoin.
I agree that, by the way, that question about who will operate the infrastructure of the network in the future, I think it is also a question for all of the proof of stake protocols as well. I think validator economics will trend to zero as well over time, and so you see the unis and aves and compounds actually run the Ethereum validators, and you maybe see maybe it is the ETFs, maybe it's so that's a fascinating question. Just sort of echoing Caitlin and also thinking about the ETFs as centralized honeypots. You're right; they're absolutely at risk, like anybody is, but they've got a lot of Bitcoin. You know, in proof of work, owning Bitcoin doesn't give you any particular vote on the governance of the network. In proof of stake, capital is consensus, right? So I think it's actually a much bigger risk to the governance of the networks for proof of stake ETFs than it is for a proof of work ETF. That being said, economic nodes do have a significant sway over the governance of Bitcoin, right? And whether those were big exchanges or big giant ETFs. You think about a simple scenario where there's a contentious fork scenario, and like, what do we think is going to be the Bitcoin after that fork? It's probably most likely going to be the one that MicroStrategy, IBIT, and FBTC say is the one.
As Andreas once called it, that would become the corpo coin.
Right, and it could. I think one thing that's really great is that if you talk to Robbie Mitchnick at BlackRock or the folks at Fidelity or all the other folks at Invesco and Galaxy, like we believe in Bitcoin. I think it's the other answer is you really can't stop anyone, including a asset manager, from buying and holding Bitcoin. It's one of the things that makes it great. So you just have to reckon with this. And I've always argued that it's better. Let's bring them in and make sure they understand why Bitcoin is valuable, so that they don't do something to or propose a change to it that would harm it.
But still, the vast majority of Bitcoins don't change hands. So in our audience is the gentleman who coined the term, not your keys, not your Bitcoin, sitting right there. And I think as Wall Street has come in and the concept of self-custody has, because of the 40 Act requirement to segregate custody from asset management, that has kind of faded, especially with the ETFs. That not your keys, not your coins mantra is still absolutely there. All of us have had to learn, especially those of us who were in the early years and before ledgers and Trezors existed, had to learn how to self-custody. And we also, in my case, I got doxxed in 2013 and lost coins there. It was the cheapest tuition I ever paid, was losing those coins and understanding that those were not really my Bitcoins.
Okay, I think we're almost at time. This one pretty quickly. Okay, well, we're going to take an extra 60 seconds. So what's the most important thing people are not discussing about Bitcoin publicly that are the most vital parts of private conversations?
Hard money.
That's a good one. Yeah, I would like to see a resurgence of Bitcoin as a monetary phenomenon and not so much as a market phenomenon. It would be great to see that. It certainly, I mean, as a narrative, it certainly is that, to be clear. But, there's a lot of number go up and a lot of 1 to 2% in a portfolio talk these days, which is okay. But would like to see a little bit more of the core thing that people, I don't know, because we're suit coiners now, and we got suits on. And I think people forget that Bitcoin's
I did the sweatshirt.
I like that phrase, suit coiners.
It's incredibly disruptive. Bitcoin is incredibly innovative and disruptive. And we have explained to the world that it's a really good thing that they should have a piece of, and they should feel safe doing it. And BlackRock's got it locked into the vault for them, and it's easy to do and safe. But let's not forget, like, this is a hyper innovative, disruptive technology for the world. So I'd like to see people really recognize that again. You kind of forget it when you get a bunch of suit corners talking about it, but it is still very disruptive.
So I love the suit coiners. I'm definitely stealing that. I think to double down on Alex's point, it's actually how we put our Bitcoin to work. And I think what got me excited about Bitcoin in 2013 was building an alternative traditional financial system. And I'd argue we've totally failed at that, but we built a really sick gold, and like that's a huge win. But what we need to do is now use Bitcoin not as a money. I disagree on that slightly. I bought a lot of really expensive coffees over the last decade. What we need to do now is we need to go use Bitcoin as a collateral asset. And that's actually how so many emerging markets participants can get Bitcoin on a solution like Core, borrow against it for stables. And now you actually have like a pristine collateral savings account, and you can pay your kind of local fiat denominated liabilities. And I think that's actually how we push forward what we tried to do, 15, 16 years ago. But I think now we actually have a path to do it.
Yeah, I agree with Rich. I think people need to recognize that BTC is much more than just a store of value. It is a super useful financial tool, and for this cycle, hopefully there will be a lot more innovative products where people can build like yield on their BTC, or they can lend it.
So rebasing the world's debt to a universal reserve of Bitcoin, universal collateral of Bitcoin.
That's the goal.
Cool. All right, that's it. Thank you, everyone.
Thank you.
Test, test. Okay. Our next panel of suit coiners is going to tell us about lending, staking, and on-chain capital efficiency. Sounds very suity. Let's have a warm welcome to Sebastian Devereaux, Lucas Bruder, Rune Christensen, Sid Powell, and Serafin Leon Engel. Okay, I think I'm going to have to ad-lib for the next 20 minutes. This is going to be fun. Oh, wait, no. Oh, we've got a couple of suit coiners.
Without the suit.
Without the suit. Okay, we've got one sweatsuit coiner. Do we have a quorum is the question. Room? There's Lucas. I mean, these are three.
It's 20 time starting on the calendar.
I think we should just go for it. Who thinks we should go for it? We've got a good crowd. This is the afternoon of the third day of a conference, so I think we should just go for it. All right, let's go. Great. Thank you very much for starting early. Everyone's going to go home 20 minutes early.
So thank you everyone for being here. So this panel that we will start live, and hopefully the other people will join, is about staking, lending, and on-chain capital efficiency. So I'm super delighted to moderate this panel. I'm Sébastien Duriveau, co-founder from the company Stakos Financial. Our mission actually is to bring TradFi on DeFi rails, and this panel is really discussing about that. It's a wide topic, but actually it's really about what I call crypto banking, taking all those activities, lending, staking, and capital efficiency on-chain. And so I think that's quite an interesting topic, because lending obviously is one of the biggest activity in TradFi. I mean, a few trillions or something quite significant. Staking on the other side is quite interesting, because obviously in TradFi you don't have cryptocurrency staking, not last time I checked, but that might be or might not be, and that will be a part of the discussion today, a key component for the future financial system, are the staking cryptocurrencies, or the cryptocurrencies themselves, part of the collateral pool, for instance, for lending. And the last point, which is on-chain capital efficiency. I'm quite sure a lot of people heard, well, crypto is great, but it's always over-collateralized lending, so it's not capital efficient. Let's see in this panel if you can go a bit deeper on this one. And I'm super delighted to be helped to navigate you on those topics with some of the smartest brain in DeFi, and I will let them introduce themselves and before just going a bit more deeply in those questions.
Hey everybody, my name is Serafin. I'm the co-founder CEO of StakeIt. We're the largest yield aggregator in Web3. So we essentially unify staking and all DeFi yields into one unified product. We make it very, very easy for our clients to bring more than 1,000 yields across more than 75 networks into their products, be it wallets, dApps, neobanks, etc. And so, yeah, we remove the complexity from accessing everything that Web3 has to offer, and we make it very easy for people to find new yields, to manage existing yields, and to, yeah, effectively make the access layer to all these yields way, way more efficient.
Awesome. So I'm Sid Powell. I'm the CEO and co-founder of Maple Finance. So we are an on-chain asset manager with a focus on institutional lending. So we currently do loans against Bitcoin, ETH, Solana, other DeFi coins. We have about 700 mil assets on the platform, and we've got a loan book of about 250 mil. But if you look at the core of what we're doing, I view it as effectively it's a form of tokenized private credit. And my background was institutional banking and securitization prior to this. But I think we all have the view that most financial products are going to move on chain for the liquidity, the composability, and the speed with which you can operate financial products like lending or staking or asset management. Yeah, very happy to be here.
My name is Lucas Bruder. I'm co-founder and CEO at Jito Labs. We help expand and channel Solana's GDP to validators and stakers. We're most well known for building MEV infrastructure on Solana, but we also built a liquid staking protocol, Jito Sol. It's the largest LST on Solana with $2 billion of TVL and roughly 40% market share. So yeah, excited to talk with you guys, and thanks for having me.
Nice, excited. Maybe let's start with you, Sid, as you are an OG in terms of real-world asset lending, and real-world asset is more, let's say, TradFi. Let's start on this angle. Can you tell us the story so far from the real-world asset lending, where it started, where we are currently, and what this audience can learn from someone that was here in the trench for the last, I don't know how many years actually, but a lot.
Yeah, almost 5 years now. So if you look at where crypto lending began, it very much began with the over-collateralized loans against Bitcoin and ETH and other large caps. Then in 2021, 2022, it transitioned into doing under-collateralized lending, so effectively focused on the credit and the balance sheet strength of counterparties. And then following the credit collapse or the pullback in credit appetite in the sector from 2023, we saw a real focus on lending or extending yield against tokenized T-bills. And so you saw 15 different projects launch tokenized T-bills, offer effectively money market funds on-chain, very low yield, and this corresponded to the Fed increasing rates along with people who are operating in crypto being largely debanked and not having access to the regular versions of these products. But if you look from there, it's then expanded. And so you've seen receivables-backed credit being a big focus because it's short duration, reasonably high yield, so it's offering kind of a comparable cost, or at least hitting the cost of capital hurdle of people who lend or invest on-chain. But the real blocker that we've had, if we look at like what does the space need to grow another 10x from here, is there's very little duration on the buy side. So most crypto people, if you offered them a product that was yielding 15%, but they had to invest for 3 to 5 years, you would find very few takers in the on-chain space. And so I think that is kind of the next unlock, and hopefully something that comes out of a more favorable regulatory environment and a more pro-innovation administration is that you start to see more institutional allocators who can invest for a 3 to 5 year duration, and then I think you'll start to see more things like tokenized real estate backed credit, middle market type lending on chain. But so far, that's where we sit today. I mean, if you look at the overall amount of leverage in the space this year versus 2022, it's orders of magnitude less leverage. The largest lending players like BlockFi, Celsius, and Genesis last cycle collectively had about 55 billion in loans outstanding. I would say there's barely even 10 billion in sort of lending on-chain happening today. So we have a lot of room to grow from here.
And maybe let's shift gears because real-world asset lending is starting to grow. There was hiccups, but it's starting. It's actually the narrative for 2025. Do you agree?
Yeah, I think. I mean, you saw firms like BlackRock made huge inroads. There's over $1 billion of tokenized T-bills on chain today, and a lot of people are saying this is kind of the forerunner of tokenizing funds. Apollo is looking to tokenize their credit fund with Securitize. We've also seen Hamilton Lane as another example of a fund manager who's tokenized their fund. And so I think real-world assets very much remain an in-focus narrative today. It's to my earlier point, it's still largely sell-side driven. This is largely asset managers who want to distribute their product on chain on the thesis that there's a marginal buyer who's just not accessing these products because they can't purchase them with stablecoins. And coming back to my earlier point, so what I think the gap is still firmly remains on the buy side. But I think as we start to see, we're already seeing more high net worths and family offices who are generally going to be earlier adopters of financial products start to invest in credit on chain. Maple had an announcement a couple of weeks back where Bitwise, who's a $12 billion regulated asset manager, used one of our lending pools. So that's an early example of a real institutional asset manager deploying on chain into a strategy. And I think we'll see more from there. And the advantage of real world assets is that they are these institutional investors are familiar with them. They all understand if you tokenize, commercial real estate, they've probably dealt with or invested in that asset class before. So it's just it's a familiar product that they can participate in.
Yeah, thanks. And Luca, you can explain a bit more. Now, we have the real world asset on one side, and as you explained at the beginning, it was only lending against cryptocurrencies, but now we have a lot of lending against staking assets, staking cryptocurrencies mainly. Can you walk us through what happened in the past and where we are today? What is the situation?
Yeah, we're seeing a lot more interest in institutional lending for LSTs and staked assets. So I don't know what the staking rate is on Ethereum, like 3 to 4% or so.
Yeah, 3%.
Yeah, something like that.
Yeah, so on Solana today it's in between 7 to 10%, depending on the activity on the network, and that is a pretty large increase in yield for those that are holding LSTs compared to the normal assets. So one instance of this, FalconX launched support for your Jito Sol on their platform. So that's kind of like the first kind of dipping toes into the institutional lending for the LSTs.
Yeah, thanks. And do you see that staked assets will replace the vanilla cryptocurrencies, or do you still see a place for those vanilla cryptocurrencies to be used as collateral?
That's a good question. I think I see a world where the LSTs are used more than the native asset, but there's a lot of barriers to get that to happen. I think the main one is taxes. And unfortunately, in the crypto world, you can move a lot faster than the IRS. But there's a big question. There's a few questions out right now on taxes that I think are the barriers to entry here. One is around staking rewards. So when you accrue staking rewards, is that income right away? Do you have to sell that, or is it not income? And then for LSTs in particular, Solana is a pretty institutional heavy chain, and so there's a lot of very low cost basis SOL holders that maybe they bought Solana under $1 or something like that. And there's a big question on like if I convert my SOL with this cost basis under $1 to Jito Sol or one of the other LSTs where SOL is at 120 right now, Am I going to have to cover my taxes? Is that like a like-kind swap? And you can get legal opinions on that, and I think it's kind of the like cutting edge on the tax side. And yeah, you can. I think there's ways around it, but it's you're a little more out the risk curve. So I think that if we can get past those barriers or get people and institutions comfortable with that, then there will be a lot more LST adoption. And I think we'll see. Hopefully, we'll see more clarity around the staking taxes soon.
To Lucas's point, we actually did a lot of lending against Sol, and we would put it in Jito Sol and other staking providers. And so the advantage for somebody who's holding Sol is that if they provide it as collateral, if your counterparty who's lending to you can stake it, then they'll give you a lower borrowing cost. If I can lend at 10%, and then I can take Jito 2x over collateralize and earn 8%, then I'm getting an all-in return of 26%, so I can actually drop the interest rate down to 4 or 5, which is what we were doing a lot with different institutional counterparties in 2024.
Yeah, maybe Seraphim, you can help us to zoom out a little bit, have a wider perspective on the staking. What are the trends you see? What are the yield components? Is it something that is shifting, or is it something stable? I mean, we spoke a lot about staking Sol, but there is ETH. But is there some other stuff that are moving around and becoming more usable as collateral for lending?
Yeah, so I think, obviously staking has pretty broad adoption already. And I think that it's cool to see that there's still a lot of innovation in the space. I think that, with Lido V3, for instance, and stuff like that, I think that there's cool stuff happening. I think the entire concept of users effectively, end users, stakers, choosing their own, I'm talking about like retail at large, right? Not like whales or anything like that, and not institutions. But retail users at large kind of like finding the right validator to stake with, to delegate to, is just such an antiquated concept. And I think that most people don't really perform any degree of due diligence at all. And will simply delegate it to a validator that they have heard of, right? And so there's a certain weird dynamic where validators have an incentive to really invest a lot in marketing and building brand equity. And I think that is not necessarily net positive for the networks that they're looking to ultimately also secure, right? So I think what we are kind of like taking this off to a tangent here, but what we're kind of like focusing on is kind of like providing multi-validator infrastructure to make it easy for end users, for retail users in particular, to delegate to any validator, to really be able to see all of them side by side, to be able to compare APYs, to be able to understand what the commission rates are that they charge. So yeah, we're trying to get people to really rethink how they have staked, and also seeing if they can optimize their stake. But in terms of like where we see trends, we definitely see a lot of trends on the stablecoin side. Stablecoin yields, real world asset. So we talked about BUIDL. Obviously, that's still kind of like an enterprise grade product. You need to KYC. There's a very, very heavy burden, like a 5 million initial deposit, in order to actually have access to BUIDL. So I think we're seeing a lot of stablecoin demand and yield on stablecoins, and we like when yield on stablecoins is kind of like composable within the issuing protocol itself. I think that's a really strong differentiator. But yeah, definitely a lot of adoption that we're seeing on the stablecoin side. About 70% of the volume that we're seeing on DeFi through our platform, 70% is for stablecoin denominated yields. But yeah, stablecoin yields, huge topic of the day, and we're excited for it because stablecoin adoption in general is soaring, and I think it's a very good focus, like a very good focal point for DeFi to hone in on.
Yeah, thanks. And I guess that's a great segue to come to Rune, a co-founder of Sky, because Sky is the biggest DeFi stablecoin, or one of the biggest DeFi stablecoin, started with lending, well, very long ago. And can you walk us through a bit more on why being your own stablecoin is enabling better capital efficiency? You're also doing a lot of work with real world assets. Maybe if you can draw a picture on this front about capital efficiency, because you are able to allocate capital more efficiently, that it was just market driven.
Sure. Yeah, so Sky, formerly known as MakerDAO, is just in general probably the oldest DeFi protocol in the whole world. And so when we started back in 2015, the space was very everything was viewed through this like original crypto Bitcoin ideological lens, really. And the original objective of stablecoins and decentralized stablecoins was to like create a dollar that's like completely out of the reach of the government or something like that. And that early on proved very popular with the DAI stablecoin, which was then the first decentralized stablecoin ever. But the problem is something called a stablecoin trilemma, which basically prevents you from scaling up the collateral of a stablecoin once you get enough demand, unless you can tap into basically correlated assets as collateral. So you can basically choose to either have a stablecoin that is basically stable or decentralized, in the sense of like the collateral being like purely decentralized, right? So with Maker, and ultimately this led to the transformation to Sky, the rebrand, the sort of repositioning of the whole project. Ultimately the decision was to focus on just giving users what they want, which turns out to be stability first and foremost, but also what's known as the Sky savings rate, so delivering return to users through the stablecoin rails. And RWA is just, I mean, it's one of many great options, because really from my perspective, and I think this is, well, I mean, I guess just the rational approach to how you deliver the best returns is that you simply tap into whatever the best risk-adjusted yield is out there, period. So it's all about developing the right risk models, and then basically executing based on what those risk models tell you around what are the assets you should be deploying into. So actually what's really unique about Sky is that it dynamically adjusts. So it's not like sort of fully backed by RWA and T-bills. It's also not completely backed by like staked ETH and like Bitcoin and that kind of crypto exposure either. But right now it's more or less like 50-50. So it's about 4 billion in crypto assets, 4 billion in TradFi assets. But that's actually changing quite a lot all the time, and it depends on where the big opportunity is. And this is just, I mean, ultimately this is the key to success, I think, especially in like Web3 finance, or whatever we call it, finance 2.0. Like the way that now the financial system and blockchain is starting to like properly integrate to each other. You have to be extremely fast, and you have to be, natively digital. And also, what's so important is like sort of decision making in all of these things, right? It's like every single time it's a decision between, should I allocate into this asset, or this, should I allocate into T-bills, RWAs, or should I go into like a lending protocol? And that's like itself a very complicated question that is a matter of having, you have to integrate a lot of data to figure out what the answer is. And yeah, we've been working on this problem in Sky for more than 10 years at this point. And I think the sort of final model that we basically launched 7 months ago with the launch of Sky, and then about 3 months ago we released the details of this framework, which is called the Sky Agent Framework, and it provides, I think, the most flexible solution to sort of solving this general problem of how to basically maximize risk-adjusted returns across all these possible dimensions, right? Basically eliminating all constraints and just like fully focusing on how to deliver the best possible savings rate, as we call it, like the best possible return, the most stability possible to the end user holding a USD denominated asset as a stablecoin.
Yeah, thanks. Maybe just to go a bit further on that front, I mean, you are saying that you also invest in real world assets, half of the balance sheet. There was a Grand Prix where BlackRock, for instance, is one of the winners. So that's kind of the coming of the institution. I think it was still saying it's mainly on the sell side. But if we move now on the buy side, Sid, there was a news recently saying that Bitwise, which for me would be a crypto TradFi, because it's not on-chain directly initially, is now investing or exposed to some Maple products, which are fully more DeFi, there are DeFi products, let's be honest.
Yeah.
So that's great. We also see Coinbase allowing their own user on their centralized exchange to be able to borrow against BTC on-chain through Morpho. So can you go a bit more deeper on if you see that institution or off-chain people are now coming, and now it starts the time where the supply side will come to DeFi?
I think off-chain institutions are starting to come to DeFi. If you look at Bitwise's case, so they have 12 billion assets under management, but they have the thesis that asset management is going to eventually shift on-chain, and what they like about the product that we provide, which is over-collateralized lending against Bitcoin, is the additional liquidity and transparency that you get by doing this on-chain. So you get a token that you can shift around between wallets, but all of the loans that you're participating in or lending against that back your position are visible on-chain, and the token provides additional liquidity. In that product in particular, we don't really have, they don't have the ability to pledge that token as collateral elsewhere, but we have Syrup USDC, which is much more DeFi and permissionless, and with that you can take it if you're an asset manager and pledge it, or you will soon be able to pledge that in Morpho to loop the strategy or to use that as collateral in order to borrow. So I think it gives an asset manager who's sophisticated additional tools and levers that they can pull, whether it's additional leverage or the ability to rehypothecate the collateral, that is extremely appealing to those managers, particularly when you look at trading firms as well. So one of the products we're very excited about is yield-bearing Bitcoin. So we are working with CoreDAO, and we're going to produce a liquid staking token for Bitcoin that's going to generate a yield in Bitcoin. But trading firms are extremely excited because they're currently already posting that as collateral, Bitcoin this is, in centralized exchanges and other DeFi protocols. But with this, they'll have the ability to earn a yield on their collateral. So it starts to become much more appealing and, I hate to use the term, but capital efficient for them in order to do that. So I think over time you will see more and more institutions try this, and the biggest competitive driver for them is alpha. If they can generate an extra couple of % of returns, that's enough to attract more LPs for them, and so that's the competitive angle that they're trying to work with. I think with Coinbase, their incentive with CB, BTC, and Morpho is that it generates more AUM for them. So by allowing somebody who holds Bitcoin at Coinbase to wrap that Bitcoin and then borrow through Morpho, it helps bring more AUM for them, more fees, and it's stickier because then that collateral, the Bitcoin, is then pledged somewhere else in order to borrow. So people aren't going to then take it out of Coinbase.
Thanks. Seraphim, I have a question for you, the $1 billion question, at least for me. I hope it will interest other people as well. But currently, there are at least three rates in this industry. You have the TradFi rates, and that's why, for instance, Sky is investing in T-bills to harness those TradFi rates or T-bills rate when the yield in DeFi are too low. You have the DeFi rates, which is kind of depending on, is it a bullish or a bearish environment? Are people willing to leverage on cryptocurrencies? And you also have the staking yield. Do you see an interplay between all those yield sources, and will it be arbitraged away at some point, or is it impossible? And how do you see those yield going forward if at some point the big players, the institution, will come on-chain to seek those yield?
Yeah, I think, to be frank, it all ties into liquid stake assets, right? We always feel like the first step in any yield journey should be liquid staking. And then taking that liquid staked asset and basically leveraging the Lego capabilities of the DeFi stack in order to find the right follow-on yield sources. And I think there were comments made about, okay, who's going to be the incremental buyer? And I think the incremental buyer still needs to be unlocked to a certain extent, because right now all of these products are obviously to a certain extent behind KYC gates. If they're really institutional, or obviously there's Syrup, which is like non-KYC, but even that, it needs to be accessible, right? And so clients that work with us, so we, for instance, with Zerion Zerion did not have any yield products at all in their product, zero, right? And they integrated our with Stake It, and they brought staking and DeFi yields to the tune of like 800 yields into their products within a matter of weeks, right? And I think unlocking that incremental buyer is super critical. And then once you have that buyer, which is a question of access, right? Which again, we're looking to solve that. We're looking to make it extremely easy to bring any of these guys' products and make them available to the incremental buyer. But I think at that point in time, it's really about providing access and then also helping users understand what are the different yields, making them easy to find. And I think that's kind of like the next generation of what we're working on, which is making it very, very simple for you to compare yields side by side, understand, because APY is also not APY, right? The term is kind of like perverted to a certain extent because you have incentive tokens that get thrown into the mix. There's certain like leverage strategies sometimes underpinning some of these structured products, which end users might not be privy to. So again, making it easy for people to access is number one. It should probably start with staking. It should then compose into some sort of like DeFi product. And from there on out, it's about making it very, very simple for people to find the next yield source. And I think that is about education to a certain point. It's about like labeling, risk labeling DeFi yields, making that easy for people to understand. And I think ultimately that's going to lead to full automation because we cover more than 1,000 yields across more than 75 networks. I think ultimately this is a very, very cool. Critical of this kind of like DeFi and AI intersection or crypto and AI intersection, but I think like for automation of yield generation, it's really, really powerful. And I think this is ultimately where it's going to go. So in terms of, is this going to get arbitraged away? Yes, most likely by agents, right? But I think it will also like make the entire yield stack like very meritocratic because right now it's you have a fixed buyer pool that needs to be privy, like there needs to be tech savvy enough to actually find these yields, access these yields, manage their positions. And I think ultimately you really want to bring this to absolutely everybody, make it extremely simple to use, effectively turning everything into an on-chain savings account. And I think that should be, fully meritocratic. And the best protocols, the best products will rise to the top.
Yeah, your point is that if you have better access, if you have better information, you can pick the right yield, and then obviously underneath, that means that there will not be a yield discrepancy because no one will choose, well, I will take the lowest yield, even if you present me all the best options.
Correct, and I think ultimately will also yield to the better quality yield products winning out because I think there are too many yield products that promise very high APYs, but they're playing around with the taxonomy, with there not being like clearly defined taxonomy with users. I mean, of course, this is like previous cycle, but if you take a look at, for instance, like all the Ohm forks, promising 100,000% APY, et cetera, right? It looks laughable, like in retrospect, but at the time it was a real thing. And I was, talking with some institutional money managers who were basically trying to tell me that even if, the token drew down by 90%, they were still earning 100,000 APY, so they'd be able to make that up overnight, right? And I think that is exactly what needs to. We need to shine a light on that, right? And it needs to be easy for people to understand where the yield comes from, and everything needs to be accessible. It should probably be automated such that real quality yields win out, and everything else kind of like falls by the wayside.
Yeah, it's quite interesting because that goes in what Ruud was saying earlier. In some ways, you are providing the access to all the yields so people can choose, and people will choose the best yield for a given risk appetite. But on the Sky side, there is one product, SUSDS, that will automatically allocate to the best source of capital, which would it be T-bills, crypto-backed loans, basis trade. I think you have few others. Ruud, maybe you can expand a bit more about how do you see the trend going forward? Do you think it will be more, we will add more crypto-backed loans? Obviously, if there is a lot of speculation, or will it be new kind of real-world asset? Do you have a perspective on what will drive the yield of SUSDS?
Yeah, so I definitely agree that in the short run, it's just about picking the super low-hanging fruit of just equilibrating the stuff that's already there and that's like completely mispriced, which is very much like I don't know what to call it, like crypto native stuff. And what's interesting is there's not really like all crypto native things that pretty much go back to like Bitcoin or staked ETH or staked Sol, and that's about it. I mean, then you have a lot of these like small opportunities for where it's about basically subsidizing the creation of new protocols that potentially can build up moats. And that's one thing where I see that's not necessarily going to go away ever as long as we're innovating new stuff. What is going to happen though is like the price of this kind of, I guess you could call it like venture TVL or something like that, is going to go down dramatically, because it'll get easier and easier to figure out, okay, there's some new protocol, they're willing to sort of overpay to get a bunch of exposure, and that's the kind of stuff that Sky and USDS and the Sky agent framework that sort of agentically does all of this will try to rapidly sort of extract all the alpha out of, right, and sort of equilibrate it as fast as possible. And then what I think will happen is once this is like totally equilibrated and it's like this complete sort of like amorphous AI process, and it feels sort of post-human in a sense, then what we'll realize is this is just like actually like a really small market, because in the end it's like Bitcoin and ETH, and like it's actually like relatively small part of the world we're talking about here, but it's just the first place where like really end-to-end AI integration can happen with finance. And so the actually exciting frontier is when we start actually to do something real with this stuff in the real world, right? And so for a long time I've strongly believed that like blockchain is like how we deliver the benefits of AI to real stuff, because it's like the most tangible way basically to sort of take things in the real world, processes, businesses, business models, transactions, and then transform them into something that is digitally native and starts to become basically starts to become something that AI can sort of directly interact with, in the sense of you can get that real-time data 24/7, and then eventually, I mean, you will see efficiency improvements of the whole world, right? As everyone is just deploying agents, automated systems, and really it's just it's just the basic process of trying to get a better yield. But over time, that will mean solving more and more complicated real-life challenges. Yeah, I think it's super exciting that it actually looks like crypto will be able to play a major role in this.
So you're saying that crypto will help finance, or at least the stablecoin, I assume, more than the cryptocurrencies, will help finance the real world, and it will be integrated with agent to find the best allocation in a way?
Yeah, I mean, I think that's guaranteed. I think, I mean, and I really believe that when you see finally this moment happening where, probably 90% of all the old world legacy institutions are wiped out, and then 10% of them survive, they will adopt AI and blockchain in parallel, effectively, right? Like those two technologies, it's such a just unbelievable paradigm shift, right? That you have to go back to the 80s and like change your code from the 80s, and when you do that, you're not gonna do that for some like small thing. You're gonna have to do it for like the whole package, and it will basically be blockchain native and AI native simultaneously.
Yeah, maybe Luca, we can take a similar question in a way. There's a source of yield for staking. I mean, and maybe you can explain a bit the terms, but there is a part that is just protocol inflation. There is a part MEV. Is there other kind of source of yield that might come, and might MEV survive if there is more optimization at the chain level? What do you think?
Yeah, I think shout out to Dan Smith at Blockworks, but he's been building a lot of REV dashboards. It's all about REV. If there's no REV, then like the chain has no usage. What are we doing here? So everything's about REV. All of that will go back to stakers. I think Solana had a crazy year, as I'm sure you guys saw. All the meme coins and trading and fees. Jito Software's produced $1.1 billion to validators and stakers. That's an insane amount of money, and that is that's going to be a major source of staking yield, especially as the way that these networks work is when you start out and you launch a blockchain, typically you have a really high inflation curve. You want to incentivize people to stake, you want network security, you want validators to run the software and take a commission on that. That inflation will go down over time because you're kind of just emitting tokens. You don't really need to continue doing that if the chain's going to be successful. So over time, any successful blockchain, the percentage of staking yield that comes from inflation will go down and the REV will go up. So I definitely think a lot about REV. Of course, apps are going to focus more on capturing value and redirecting value to the devs or the token holders of the app, whether it's a DEX or something else. But I think on Solana specifically, you will see more and more block space being created, and the meme coins are a big battle test for Solana too. So Solana engineers are learning a lot from that. 2 or 3 months later, chain gets better, more block space, more REV, and so on.
And do you have a view on the fact, so your answer is it's really block space, there will be more block space, more demand for the block space because it will be kind of more valuable. Obviously the question is, do you create more block space or are you creating some scarcity? And do you see a value or a source of yield from the LRTs, so the raw staking of already LST, which is a liquid staking token?
Yeah, I think every blockchain has to continue increasing block space. I can't think of any tech in the past that is like, okay, we should just stop here, like we're good. There's a pattern of technology getting better, getting faster, there's more abundance. That's certainly the path that Solana's on. And so MEV and priority fees and this payment for hot state is going to increase. And that happened on Solana in the last year. I think that will continue to happen. There's certainly more kind of risk taking out on like the VRTs. We call them VRTs on the Jito restaking protocol, some of the LRTs. But yeah, I think that like MEV and priority fees and this REV going to stakers is going to increase.
Going to increase. In proportion, you mean? Or just in absolute numbers?
Both, yeah. I mean, we're kind of in a lull right now. Things got a little crazy. Cooling off, taking a breather. Everyone's fixing their tech debt, but I'm pretty confident it's coming back, and Solana engineers are working pretty hard on making more block space.
And Seraphim, do you have a broader perspective to bring here? Do you agree first with this statement, or do you see things a bit differently?
No, I think Solana is definitely leading the charge in terms of like on-chain innovation. And also to a large extent, obviously, to what the Jito guys are building. I think it's cool to see more DeFi come to Solana. I mean, bit by bit, but 2.3x year over year is pretty healthy. While obviously Ethereum has kind of like been now year to date kind of flat. But yeah, I mean, we're excited to see more on-chain innovation. I mean, obviously, given that there is going to be more institutional demand, and be it even on the on the sell side for now, like we're excited to support it. Yeah.
On the risk-taking, do you see it more capital efficiency, or do you see that's a trend that will continue to grow and becoming something a bit more tangible, or is it something that will be only part of the staking?
It's a good question. I think for the kind of like super crypto native cohort, it's going to be a major source of alpha and can continue to be. I think that for everyday users, like we're kind of like straddling servicing clients like Ledger and Xerion, which have very crypto native user bases, to now even like CeFi applications and like neobanks. So I think, to be frank, for the very crypto native cohort, yes, it is going to continue to be a source of alpha. I feel like for the more average user, it is they're just going to be happy to liquid stake their SOL, right? And get some additional rewards on that, or potentially deposit it into a DeFi app, a DeFi protocol. But yeah, I think for the everyday user, probably not so much. It's going to probably be still pretty crypto native, even if everybody has access.
We've seen a couple of proposals for LRTs or liquid restake tokens like ETH on EigenLayer to be used as first loss capital for lending. So I think as long as the fee income coming through is relatively de minimis at the moment, people are looking for other utility. And one of the ones proposed has been to effectively provide it as outsourced collateral for borrowers, which could include market makers or other on-chain funds. And then that would serve as collateral to protect the position of lenders who want to get a stablecoin yield. So it kind of helps power more sort of on-chain lending and on-chain credit origination. I've seen two proposals for that so far.
Yeah, and so that means that the cryptocurrency side, the staking, could help provide some protection for lending against real world assets. So
Yeah,
there will be a complementarity between the real world asset and the staking?
Yeah, so staking can both secure the network, and then it can also be used to secure credit as well.
Yeah, that's an interesting perspective. Does anyone wants to add something on this particular point? No, otherwise, I have a question for you, and that's the alpha part of the panel. What is, for you, exciting for the, let's say, 2025, 2026? What are you super excited about that maybe this audience is not aware of or not paying enough attention to? Maybe let's start with you, Seraphim.
I'll have to probably go back to real-world asset yields. Just make them super accessible for everyday users in kind of like crypto-first products. I'm very, very bullish on this new cohort of CeFi products, funny enough, just because, and obviously also innovations such as like Infinex, et cetera, that just make it easy to be super crypto native. But yeah, real-world asset yield, things such as BUIDL, which hopefully will cross over into retail at some point soon. Very, very bullish on that.
I think for me, I'm looking at the Bitcoin yield space. So things like core liquid staked Bitcoin. I think this unlocks a lot for lending and borrowing. So as I said before, if you can accept it as collateral, you can lend at lower rates, and it becomes a real competitive advantage. Not to mention the fact that there's a ton of people who are sitting on Bitcoin or holding it, and they're not really getting any yield at the moment. And so I think it's a large addressable market. It's been relatively underserved to date, but it also has a lot of crossover for the lending and the credit space. So that's what I'm most excited about.
I'm most excited about two things. I think one is institutional adoption of LSTs. There's a few barriers and walls to run through to get there, between the security status, which the Jito Foundation put out a report about the security classification of Jito Sol, talking about how it's not a security. Hopefully we'll see more insight from the SEC soon on this. I know it was on Hester Peirce's list of things to get clarity on, and hopefully it looks something similar to the meme coins are not securities document that she wrote. And yeah, I think just like more policy clarity for builders in the US. I think from a liquid staking angle, and also just like being an entrepreneur and the Operation Choke Point 2.0. And we saw Trump give a video presentation earlier today, and he's definitely thinking about it, and there's a lot of people in DC thinking about it. So I think it's something that people from the outside, it seems like something small, but for builders in the US, it's really big. You spend the past few years like worrying about these things and wondering if you need to leave the US. And now it's like, okay, it's coming back home. And I think there's a lot of builders in the US that are excited to see that.
Yeah, really quickly, a prediction or something that is super exciting?
I mean, in Sky, the most exciting thing is definitely the launch of the first couple of Sky agents that is coming up. I mean, actually just, well, you mentioned it, the Spark tokenization Grand Prix. So the very first agent called Spark just announced yesterday that they're doing this 1 billion deployment into BlackRock and a couple of other really interesting tokenized assets. But it's just the beginning of Spark reaching this escape velocity of a lot of autonomy and a lot of agency in deploying the $8 billion plus capital pool out of the USDS stablecoin. And there's just going to be more and more of these agents launching. And every single time there's another one, it's just another kind of accelerant on this process we've been discussing the whole time, right? Of equilibrating yields, increasing efficiency, and starting to have an impact on the real world.
Thank you very much. We have to close here, but it was super enjoyable to have you on this panel. Thank you very much.
Thanks for having us.
Thanks.
I think the early start worked out there. There was a lot of knowledge. I don't think we were going to pack that all into 20 minutes, so that was good. For our next panel, there's a law of headlines that says that any headline that is phrased as a question, the answer is always no. So I'm curious to see if that applies to panels as well, because the next panel is, do VCs still matter? Our panelists are Boccaccio, who is one named like Madonna or Ronaldo, Hasib Qureshi, and Mike Dudas. Let's give them a warm welcome.
Testing.
Great. Mike, Hasib, great to be here with you both. Thank you so much for taking the time to chat with me.
Thank you.
Yeah, let's do it.
Today we're going to be talking about crypto and VCs, specifically if VCs still matter. Before we get started, do you guys want to give a short introduction of yourselves?
Short introduction, I'm a VC.
Yeah, I'm an extremely consequential VC.
I still matter. That's my intro.
To get us started, why do you still matter, I guess?
I feel attacked. I will say I feel attacked. So maybe we should start with like why VCs don't matter, because obviously, I think this question would have seemed very strange even just a couple years ago. We've seen the rise over the last couple of years of a few trends that are kind of these anti-VC trends that have emerged. One of them, of course, being the rise of these crowd sale platforms like Echo. And of course, Coinlist pre-existed for a long time, but Echo is kind of defining the current meta. The second trend is the rise of meme coins and launching startups not through VCs, but through something like Pump.fun, beyond just meme coins. And then the third has been the rise of these purely quote-unquote fair-launched projects like, the two most prominent examples have been Jupiter and Hyperliquid, which were entirely self-financed, airdropped to community, no VC allocation whatsoever. So these three trends, I think, are defining something different about this meta that feels not like previous cycles where VCs were just assumed to be part of the baking process of how startups get created.
And there's a fourth one, I believe, which is the way that VC coins, meaning VC-backed projects, have launched, looks to many people, and based on price action, to be extractive. But what we'll argue in this panel, is that that's not solely or even perhaps primarily due to VCs, but to structural things about exchanges, et cetera.
I mean, I think that vibe shift has already swung back just because like meme coins are down so much from the high and VC coins have outperformed over basically the last 3 months. So I feel like I'm not feeling as much of that of like, oh, VC coins, high FTV, low float, blah, blah, blah. That kind of hit a crescendo like mid last year. But it feels like that's really come in since the beginning of this year just because all the meme coin financial nihilist people are just kind of down so bad they don't speak up much anymore.
Okay, fair. So we've checked one off already. Good, we solved that.
Yeah. So I think those are the reasons why people say, oh, hey, do VCs still matter? So I can summarize my counter arguments and curious what your take is. So so the first prong is Echo and these kind of crowd sale platforms. The reality is that if you look at Echo, so actually the recent Echo sales that have happened in the last month or so, most of them have actually been pretty shitty. So they've kind of underwhelmed. They didn't sell out. So that's been disappointing. But if you look at the really big ones, they were all VC backed, right? So like probably the most famous one is Mega ETH, which we actually led Mega ETH's most recent round before their Echo sale. And so if you notice like on Echo or you look on Legion or whatever, almost every single one of the projects that are listed there are VC backed.
Literally, I'm an angel investor in Legion, and they ask me before they offer a token or equity to folks on the platform, hey, is this a legitimate project? So VCs are basically, I would say, the single best signal of what should be listed on these sort of open community launch platforms.
Exactly. So like VCs, I mean, obviously VCs have multiple different functions in the market. The reality is that one of the functions of VCs is kind of as underwriter. And it's obviously, I hope there are no regulars in the room, but like that's kind of the way that the market looks at it. It's like, oh, well, this is a Dragonfly quality project. This is a Hack VC quality project. Okay, what does that mean?
Those are the same, right?
Yeah, exactly. That's what I'm implying. And so that signal, the market takes that signal very seriously, right? You go look at something on Legion or Echo, first thing you look at is who are the VCs? You don't look at, oh, well, let me read the white paper and like look in the background of the founders and like go trace their LinkedIn and read every tweet they've ever written. We do that. Retail investors do not do that, right? Because they don't have time. There's no, it's like this specialization. This is what the foundation of every fucking market ever is, that some people specialize and do certain work so that other people don't have to. So that's one thing, is that and you just mentioned you're an angel investor in Legion. Legion is VC backed. So like
VC backed and incubated.
yeah, exactly. And CoinList VC backed. Almost all these platforms are also themselves VC backed. So the idea that like, oh, there's all these things that are circumventing VCs entirely is kind of a bullshit narrative.
By the time the thing gets to the point where it's a community fair launch project like Hyperliquid, thing's been in development for multiple years. In the case of Hyperliquid, fortunately, there was a wealthy set of founders who could self-fund the thing to the point where it could get to a public launch. In most cases, that's not possible, and you need folks who will underwrite with a time horizon of more than 3 weeks, because let's be honest, like the things today that people are excited about is not the same things that they're going to be excited about 1 month from now. You look at anything that's quote unquote hot right now. This could be a SocialFi project, a GameFi project. This could even be, we're getting to the point where like stablecoin projects have, if somebody invests in it, they literally people are expecting returns, they're expecting growth. They don't want founders to be heads down for even 6, 9, 12 months. They want a product that is growing, that they can talk about, that people can see tangible results within literally days, weeks, months from the moment that they put money into it. And they're expecting, many investors today, this goes back to the ICO days, liquidity. They're expecting that within months. And that's simply not the way that long-term durational businesses are built. If you look at the best ICO projects, many of them, Aave would be an example of this, right? I think, what was the ICO, like 2018? Aave is hitting its absolute best stride today, 6+ years later. And frankly, because it's had support from, wait a moment, VCs in the liquid markets, in foundation sales. I guess I'm getting ahead of the point. We were talking about sort of early private VC, but what's happening now is we're seeing many projects that I would argue got sort of caught up in this fair launch meta. You look at pretty much any AI agent project that launched a token, the token went up to X, the token's down 95 to 98% from X. And the company was not able to sell. There was no buyer. They didn't even get any portion of supply, and they're sitting on like, hey, we've got a couple $100,000 and we have a team, and like, what are we doing? Like, I don't know how we're gonna do this. Hey, Mike, or hey, Hasib, are you guys willing to invest at a pre-seed valuation? And let's get out there and let's jumpstart this business. Here's our pitch deck, and we're like, what do you mean? Like you literally already put your value out into the world. You have a community. You have a product out there. People speculated on it. They perceive the token as the product. And there's probably a really great platform here that you want to build, that you can build, but you sort of shot it out there. There's nothing, there's not a second chance. All right, I made like 10 points there that weren't coherent. Bring me back to coherence.
Yeah, look, I think you made an excellent set of points. And starting with, starting with the Hyperliquid thing, like Hyperliquid was funded to the tune of like $10 million+ before launching their token. The number of founders who can do that is basically zero, right? Like almost nobody. It's basically Hyperliquid and Jupiter, both self-financed, huge amounts of money that basically their founders were independently wealthy. Almost no founders are in that position. So that makes it very, very difficult for people to really follow their footsteps. Now, you look at most of the other fair launches, like, I don't know why people still think that this is a good idea. You go back to the last cycle, the classic fair launch was Yearn, right? That they literally invented the fucking term. And Andre Cronje, to this day, complains about what a horrible idea it was to fair launch, right? He's now like 5 projects later being like, man, I should never fair launch anything. You people are animals. Like, you guys treat founders like shit. I should have just raised from VCs, right? And he's the guy who made the whole thing.
He still can't help himself, though.
Yeah, no, totally. So, like, I think if you look at, I see the same thing that you see, which is that a lot of these projects that were like, hey, fair launches are cool. We should do fair launch. They do a fair launch. They have a token out there. Retail speculates on the token. Token's worth $100 million. They come to us and they say, hey, I own like nothing of this token because I don't know. It just happened. We got excited. We did a thing, and like I think I might have a business. Can we raise VC money? And I'm like, for what? You don't own anything. There's a meme coin that's out there that's like trading, and they're but we'll like change the we'll like make them give us some more token. Like, dude, do you see what happened with Jupiter? When Jupiter was like, hey, our team doesn't own enough of this token. We would like to ask the community to give some tokens to our team. And the community's like, fuck you. Your token's already down. What are you doing to us? Right? Like, okay, well, yes, this is what happens when you basically put corporate governance in charge of random people who got free money. Right? They say, yeah, they don't know what to do. They're just like, that sounds like a lot of money, and my token's down, so you're a dick. Fuck you. Okay? This is why companies are not run by shareholders. Because, like, yeah, people are emotional. People get mad. People are like, yeah, I'm down and I'm mad and I want you to pay for it. And this is not how VCs operate, right? Anytime you see one of these class action lawsuits against a token founder, it's almost always, it's a retail investor. It's always a retail investor.
Who spent $7? Who spent $7?
Yeah, a retail investor who spent $7. That's often also the case. So, like, the reality is that when you're building something, it takes a long time to build something. And crypto is volatile as hell. It's crazy to try to build a crypto startup. So you're going through these ups and downs. Sometimes you're a hero. Sometimes everyone hates you. Sometimes things are going well. Sometimes they're going terribly. And the value of VC is that we get it. We're patient. We understand what you're building, and we can actually help. We're not just in your Discord every day asking when token.
Yeah, and the only reason, or one of the reasons that that VCs are not viewed that way, we should delineate. Like, Dragonfly is a great VC. I think Six Man Ventures is a great VC. There are a lot of really atrocious VCs, right? There are prop shops. There are, scammers. There are a tremendous number of people out there giving money to projects, market makers, active market makers who are supremely
I think you just upset some market makers.
Do we have any active market makers?
Oh,
okay, all right. Can you please leave?
It's fine. We don't need them. We don't need them. Do market makers matter? That should be the.
That's depends on if the coin has any value. If not, they do. Sorry. But the point is, there are a lot of folks who are called VCs who aren't. I think what we're, just to be clear, talking about are folks who have built businesses before, who have built protocols, and are going to be with you for 3, 5, 7, 10 years, whatever the journey is. And sure, hey, may sell tokens at some point or equity along the way, but in conversation with the founding team, explaining the reasons for it, continuing to hold generally unless situations change and bad things happen or whatever the case may be. But the point is long-term partners in your growth journey. And so that's not the default still. I would argue there's probably only 15 to 20 firms that operate like that in crypto. So I think good VCs matter, bad ones don't.
Okay.
You only asked one question so far, right?
Yes.
Okay.
Sorry, I thought he was going to be more chill than me, but
I'm here for it.
All of the questions I had written down as well. So I'm going to have to take the opposite side and say, what is a valid criticism of good VCs right now?
What's a valid criticism of good VCs? I think one thing is that a lot of VCs, and a lot of what I would call even good VCs, they bullshit a lot. And this is one thing that I think I can see it. This is one of the reasons why we've grown in popularity as a firm, is that we say what we actually think. If you look at a lot of firms in crypto, even like some of the most stalwart firms that you think of as like, okay, these guys are great, good actors in the space. They've been good stewards of the industry. They've been helping us on the regulatory side. A lot of really great stuff, but they don't own the mistakes of the industry. And the reality is that we have fucked up so many times. Like if you just look back of like NFTs or play to earn or Terra or FTX or like all this stuff, and like there's a reason why a lot of people look at what VCs do and are like, you guys are not that different from us. You're also investing in scams. You're also doing a lot of stupid shit and enabling bad behavior. And it's true for a lot of VCs. And being able to talk lucidly about it is something that most VCs just do not do. And I think that's one of the reasons why a lot of VCs have lost trust with many people in the community, is because the community sees it. It's like, yeah, obvious. we were hearing you guys talk about play to earn constantly, and then it just totally collapsed, and no one like admitted it. That like, yeah, you guys were helping enable this thing, and I think that is that's a large part of the heart of why people find VCs to be so distasteful.
Absolutely. Like another example would be, hey, we need to sufficiently decentralize, and like the entire thing here is we're doing that over time. And then like, let's be honest, like you saw the Uniswap proposal, like we've seen a bunch of others that are controlled by a very, very concentrated group of folks who are basically putting out research papers, thought pieces, tweets, this, that, and the other thing, who are funding, you know, the 70th L1 of this year, who are like literally, if we look at like the biggest L1 that's like going, like Story Protocol, for example, while we're saying like, that's like, why does that exist? I don't know. It doesn't exist organically in any way, shape, or form, while putting out a bunch of really highfalutin moralistic pieces about everything else in the ecosystem. It's bullshit. Be fucking honest about the industry. And I'm getting tired of it. It sounds like Hasib is too. We're very honest about the things we support. We're investors in Pump.Fund. I believe that Pump.Fund, in the long run, will be a very positive protocol, a very positive product for the industry. And I'll stand behind it. And I'm not going to bullshit you and tell you I don't stand behind it. At the same time, we invest in stablecoin products. But I'm not going to put out a bunch of pieces, not talk about things publicly that seem somewhat, you know, like, or say this thing's unsavory, while in the background, I'm voting for extractive things for the protocols I've invested in, and then investing in a bunch of L1s that are useless and propping the price up.
So would you say that we have too much infrastructure right now?
Of course.
I disagree.
Go for it.
So the whole idea
He's invested
of
a
this,
few more L1s than I have.
Yeah, this guy's a Pump.Fund guy.
Yeah, we'll get into this.
Land.
Monad versus Pump.Fund.
Yeah, that's right. So look,
actually an angel monad. So
I think it's a very simple. I think it's a very simple equation, which is that are we done? Are we done building blockchains? Right? Is this the final form? Like right now, Solana. All we had to do is get Trump to launch a meme coin, and Solana fucking collapsed it on itself. Like, you know, Phantom fell over, nothing was working, the RPCs are all dying, and you're really going to tell me that, like, yeah, we're done?
That's because Phantom misconfigured a bunch of shit.
Like, look, the reality is that if we want more than 10 million people to be using public blockchains, we're not done. We're nowhere near done. There's no fucking technology.
Is Mega ETH the answer?
What's that?
Is Mega ETH the answer?
I think it's a shot on goal to try to come up with an answer. And there's gonna be many people trying to answer it, but like it's like saying like, well, who could possibly want more than like, you know, a gigabyte of RAM? And the answer is like, yeah, fucking the entire world needs way more RAM, way more scaling, way more everything. So no technology stands still and says, you know what, we have too much infrastructure, we're done now. We're not gonna make more computers, we're not gonna make more GPUs, we're not gonna make more RAM, we're not gonna, you know. No, the answer is obviously no.
And by the way, the reason I can take your answer seriously is that you guys do invest in some of the biggest applications in crypto as well. I'm not going to kiss your ass too much, but like Athena and a bunch of consumer stuff, DeFi. So, you know, DePen, right, Don, which we invested in. So I think you earnestly believe that. I do think there are some other large cynical investors who would default about 80% to infrastructure investment, and I think that's a problem. I think
I take the other side of that too. Like, so let's say there's a VC out there who doesn't invest in applications; they only invest in infrastructure. I think there's nothing wrong with that VC. I mean, at the end of the day, if they're investing in bad infrastructure, okay, that's malinvestment. That's bad, but like they internalize the cost. Or the
problem is there's no bad infrastructure investments right now because of the artificial.
That is not true.
I read your Solana piece, and then I saw you saying, look, you don't hear about the ones we invested in that didn't work out.
Yeah.
But the issue is that the structure of the market is such that it only takes a couple infrastructure investments that get hot, that capture the imagination of global retail, not that much liquidity in the grand scheme of things to actually return on that.
Go look at the portfolio of like a random Chinese fund that's backing random infrastructure projects. And look at their,
but it gets back to your earlier point on because Dragonfly blessed this thing, people will invest in it. And
not
I do believe
because Dragonfly invests in this thing, right? Like we invest in this thing because it's good, and retail investors see that as a signal, but it's not causal, right? If we didn't invest, some other great VC, maybe you guys would invest, and people would look at that.
That
and say,
might be true. Actually, you've done a good job. You actually may be the best, but the L2s like they're straight down. Like look at Scroll, look at a bunch of these other ones. And these are ones that retail invested in at a very high valuation because of that check mark. And honestly, that's the trend. Like the aggregate value of all these things since launch is massively down.
Absolutely, but that's true of everything, right? That's true of everything. What is the exception to that rule?
Bitcoin in the same time
Okay,
period.
so
like
Bitcoin.
Solana,
Yes, okay,
Solana
so
in the
Bitcoin's
same
doing
time
well,
period.
alts are doing badly. So like, okay, yeah, L2s are down.
But like Solana. in the
Okay,
same
but
time
like, well,
period.
look at applications. Like, what about gaming tokens? What about any of these other things that you could have said? I don't want to own L2s. I'll own this instead. Go own some IoT tokens. Go own some fucking.
What's interesting
data
is like,
tokens.
yeah. So
Own a GPU marketplace.
So it's a question about tokens now. We're getting a little far afield of the VC, but I will go with tokens.
I think we're right
There's
on
a
top
question
of
of
it. I think
whether
we're right on top.
Yeah, the question is whether there's sustainable token value, right? Like we invest in STEPN and play to earn.
Yeah.
We invest in something I believe. I'll actually address this one head on. Like the pitch was move and earn, and we're going to have sinks. And by the way, they didn't create the sinks. Like they created something that
I mean,
wasn't what we invested in. Is that the VC's fault? I don't know. There are, by the way, a bunch of mechanisms trying to come to market to try to correct for that. The reason gaming hasn't worked, I would argue, over the last 2-3 years, I think it is a segment or a sector that will work, is because crypto is inherently speculative. These are things that trade 24/7, 365. That's the point. It is the product for these games. We've been investing in much simpler things, right? So things that people, like you've seen, we're investors in Magic Eden. It does well because there's just constant flow through it. Again, STEPN did incredibly well because they had their own AMM. They took fees. There was just constant flow, pump.fun, nonstop flow. We're doing one called football.fun, which is effectively so rare, but the actual players are liquid tokens. I think that's a good thing. Like people want to actually have fun, speculate, and use these things nonstop. But to your point, we've, as an industry, had a horrible track record of creating long-term, sustainable, durable value for tokens, outside of infrastructure. Fucking kills me to say that.
Well, I'll take.
I
that
worked
as a
through
W.
that in real
I'll take that
time.
as a
You're
W.
welcome. Like I
Okay.
just actually worked.
But I will look. I will say this: is that like I don't fault people who invested into play to earn at the time that it was hot, right? I think like there's fog of war. Nobody really knew how it was going to play out. But once it's over, and everybody sees very clearly, okay, play to earn doesn't fucking work. Play to earn is a disaster. Like giving people free tokens to play your game is fucking stupid. Right? It's like the opposite direction of how the flow of capital is supposed to work, is that gamers are supposed to pay money to play your game, not get paid.
They did buy NFTs, but then the value of those NFTs was
so right,
rugged.
exactly.
Yeah,
so like this
yeah.
whole, like, yes, okay, there were multiple steps in this process, but like that concept is just it was backwards land. It was just like fucking ass backwards stuff that we all collectively just sort of wound ourselves up into. Like, oh, this kind of makes up metaverse. This kind of
ownership economy, sir.
Yeah, what's that?
Ownership economy.
Ownership economy. Yeah, absolutely. And so, look, the collective delusion, we all had it, right? And I found myself, even when I was criticizing play to earn, and I was like, this is unsustainable bullshit, and it obviously doesn't make sense. I was like, fuck, maybe I'm wrong. Like these guys are making all this money, STEPN's going up, and Axie Infinity's going up. Like maybe I'm wrong. And of course, you cannot be human and not have that voice in the back of your head that maybe I'm wrong. And financial alchemy has totally worked, and like the laws of physics have been reversed, right? You just never know. You just never know. So turns out it didn't happen. But like, what's the learning? What's the learning? Did we learn? Like, okay, if we learned, tell them. What did we learn? Like I think the answer is that, of course, the economics of any system need to make sense from the beginning.
Correct. Yeah. So you have to have an actual buy-in, like
Yes.
a real buy-in. The earn component can't be juiced so much that it becomes economically like irrational, and there have to be real sinks. And the sinks could be I have to stake or pay to earn more value in XYZ. That being said, it's yet to be done. I can't think of a protocol that's actually demonstrated this in gaming yet.
Yeah, look,
to
I mean,
date.
I'm generally pretty skeptical of gaming, but I will say that I think you're absolutely right. The core, the beating heart of crypto is always about money.
Yep.
And the best game you can play with money is gambling.
Correct. Yep.
And so I think in that sense, Pump.Fun is the best game in crypto.
Yes.
And I think if you think about it as a game, suddenly it's like really obvious why it works so well. Is that you're sort of role playing being a crypto trader, but the crypto trader tickers are all stupid pictures of memes. And the volatility is like jacked up to 11. Liquidity is basically 0. Everything turns over in like 24 hours.
And they're going to move. I mean, you saw they launched AMM today. They're going to move into reward. Like they reward creators. The whole design is reward creators who create these pools. It's effectively going to be TikTok with money. We'll see if that works.
Yeah.
But like the amount of time people spend on these creator platforms, there's a plausible scenario in which just time equates with money. Time.fun is another one, by the way.
Sure.
I don't know why it needs a token per se. I don't know. Like maybe I can make more money than $40 per tweet, or sorry, per DM. But I do think this like sort of time for money and attention does have some element of.
Okay, now we're slightly off topic. What
sorry.
what are we supposed to be talking about?
We have one. I think we can do one more question, which should be on meme coins. I think. Where do you guys think that is going? We've had the past year and a half dominated by meme coins. Will that last? I know we touched on it a bit, but I feel like this will make you guys fight it.
So like Austin Campbell at the back of the room, I think meme coins are the most important innovation in crypto, since Bitcoin.
The most important innovation. Okay. All right, because I was ready to jump
he
on
hates them. You start.
Okay. Yeah, I think meme coins are basically. I think they're basically fine. I think the philosophy that generated around meme coins was extremely destructive. Like this idea that, well, nothing we built here matters, all this financial nihilism shit. I think that was really, really bad for the industry. I think it's clearly already peaked and it's on the decline. I think, I'm telling you things you already know, which is that meme coins are down bad. Everybody suddenly feels stupid. All the generational wealth that people thought they had, they lost it all back, which is always what happens in every single one of these cycles. People think they're now unfathomably wealthy, and there's 5 people who actually cash out, and everybody else is just greedy and just keeps playing the game until they lose it all back. And so I think the story, one, is that Pump.Fun made an amazing game. That game was very popular. I don't think the long-term equilibrium is going to be, well, meme coins go away. Obviously, we're not talking about the big meme coins like Doge or things like this. These are very different from the meme coin game. The meme coin game is played with these low-cap shitters that are coming out every single day. That's the meme coin game, and that's what we're talking about. Doge is Doge. It will always exist. It'll never go away. I think for this game, the meme coin game, I think it's going to pancake over time. Probably not yet. Probably there's going to be another run of the mill when we have some macro reversal and risk assets go up, and it's like, oh, suddenly everything's okay again, and we have like a second hump. I think it's probably going to happen with meme coins. But people have already lifted the rock and they see all the little bugs of Kelsier Ventures and Melania and all these snipers and grifters that are taking a piece of the action, and suddenly it doesn't feel quite as pure and quite as rebellious anymore. Now it kind of feels like, oh, I see the supply chain of the casino, and I see all the little fees and I see all the firms that are optimizing the casino slot machines to extract the exact right amount of money from me every time. I read a book about it, and now I know it's there, and I can't unsee it. I think more and more people feel that way about meme coins, and that kind of means that the movement can't quite, get all the way to where it was previously. But my claim is that when this stuff pancakes, and memes don't automatically make money anymore, there will be some cohort of people who will just keep playing this game forever. Even when it stops making money, it stops being cool, it stops being the thing that everyone's doing. In the same way, there's still people buying NFT mints. There's not a ton, but there's still people buying those NFT mints, and they're just going to do that forever. I saw a documentary recently, a short video documentary about Cookie Clicker. How many people know? Do anyone know what Cookie Clicker is? Only a few people. Okay, you know Cookie Clicker. So Cookie Clicker is this really terrible idle game. It's basically like a browser game where you click on a picture of a cookie, and you click enough times that you can make things that automatically will click the cookie for you. It's the stupidest game ever invented. But it's there was a moment in 2015 where this was a viral game that everyone played for 10 minutes. There's people who still play Cookie Clicker. And they interviewed one of these guys, and one of these guys was like, I will play Cookie Clicker until I'm an old man. And I want my kids to play Cookie Clicker. And for any game, no matter how stupid it is, there's somebody who's just they're just never going to let go of that game. And for meme coins, I think there's probably 50,000 people for whom they will never let go of meme coins, no matter what. Like there will be a new hot thing in crypto, there will be a new trend. Everyone's gonna be making money and getting unfathomably rich on the new thing, and everyone else is gonna feel stupid and way too old. But the meme coin guys will be like, but I just love trading pictures of the coolest memes.
I think they're going to evolve a bit. I just talked about the TikTok thing.
Yeah.
Creators are going to everybody's going to have their own coin. In the same way, like, dude, if you told people 20 years ago that people were like, my kids like want me to buy like Roblox, Robux and Fortnite skins and this and the other thing, it's like we would have said 15 years ago, this is completely worthless. I believe that meme coins are sort of the evolution of attention. By the way, even getting more specific, like it's not a perfect analogy, but like 90% of the S&P 500 is an intangible value, right? There's just not that many hard assets in the world anymore. There's brand value, there's like attention value, there's IP value, like whatever. Bottom line is we're moving to a world of like very few, in my estimation and like the actual data, hard assets, and just a lot of value around attention, things that are cool, things that are hip, things that people talk about, and things that people are paying attention to. I think the number will be more than the 50,000 people. I think it's that meme coins tied to, or tokens, again, value, tradable value, tied to attention, tied to personalities, tied to the things we cared about, tied to communities, will actually be a significantly increasing portion of where people are allocating their, hard-earned McDonald's salary to. It's just going to happen because there's the potential, as we talked about, it's a speculative economy for 100x. And that's increasingly what people are looking for. Whether it's sad or not, it's the reality.
All right, I just wanted, before we wrap, I want to take a quick spot check of the room. So given our two views on meme coins, how many people, raise your hand, agree with Mike's view of meme coins? Okay, how many people agree with...
You guys are getting it so rich.
How many people agree with my view of meme coins?
Relatively split.
It's pretty even.
Yeah. Yeah.
This is what makes markets.
Okay, that's good. All right, I guess we'll see in a year or so who's going to turn out to be correct. What about digital?
Didn't that go away?
Digital land? Yeah,
Sandbox? He's the guy buying Sandbox still.
Okay.
There are 1,000 of those.
There's somebody still buying everything that existed in the last cycle.
My friend Drew Austin is still buying Sandbox land.
That's beautiful. That's beautiful. Wonderful note to end on.
I'm sad we have to end it, but Mike, Asif, thank you guys so much for coming on.
Thanks for having us.
All right, well, that was awesome, which makes me sad to report that this is our very last panel of the 3-day conference. I don't know, Mike, can we do one more day? We'll see. I don't know, check back tonight. Maybe we'll have one more day. Fortunately, our last panel is a good one. We're going to talk about where macro and crypto collide. Felix Jovin, Austin Campbell, and Joseph Wang. Let's give them a warm welcome.
Well, in the great words of Monty Python, and now for something completely different, we're going to be talking about macro and crypto and how those worlds collide. So I'm excited to be joined today by, I'll let them both introduce themselves, but maybe we'll start with you, Joseph.
Oh, hi, my name is Joseph Wayne. Some of you might have seen me on Forward Guidance before. So I run an registered investment advisory called Monetary Macro, and also I write a weekly newsletter at fedguide.com. So my background is in central banking and financial markets.
Austin.
All right. Hello. I'm Austin Campbell. I am a professor at NYU. I unfortunately know more about stablecoins than is probably healthy for any individual human being, having run and built some myself in the past. And I have a long and somewhat tortured career in traditional finance as well.
Nice. Well, that really sets the theme here for what we're going to be talking about, of tying those two worlds that seemed very different and separate just a couple years ago, or even just 6 months ago, and seeing how those two worlds are colliding. So I want to start by just digging into getting everybody up to speed on how what's the right way to think about macro as it stands today. So obviously we had the FOMC meeting yesterday. there was no real surprises there in terms of the rate cut changes, but there was a lot to dig into. So I'm actually going to pass it to Joseph. I would love for you to just explain what were your main takeaways there. How are you thinking about the FOMC today in light of what's going on the fiscal side as well?
I think the FOMC meeting could be summarized by, so basically Chair Powell, if you look at his projections, March FOMC was one of those special FOMC meetings where we get dot plot projections. You can see that the FOMC is really, really uncertain as to what the world will look like in the future. In the dot plot, basically, members there say that the risks are to the downside for unemployment and very high uncertainty. And for inflation, risks are to the upside and also very high uncertainty. We have a lot of things happening in the world that make macro super interesting. When it comes to policy, you have changes in fiscal policy through DOGE, you have changes in immigration policy through enforcement of the border law, you have changes in regulatory policy, which many people have been discussing today, but that actually impacts a whole aspect of industries from oil to banking. And of course, we have some changes in trade that we will find out on Liberation Day on April 2nd. So we have all these things happening right now, and so no one really knows what's going on. So the Fed has basically committed to be reactive, committed to basically be late no matter what happens. So what they're going to do is that they're going to wait and see what happens, look at the data, and then react. Now, my best guess is they're going to find out that the data doesn't actually look so good because of all these changes, and we'll have some aggressive round of cuts. But at the moment, the market is only pricing in 2 cuts this year, which is also what the Fed guided towards at their dot plot. Now, one other thing that happened at yesterday's FOMC that was pretty interesting was the stance of the Fed's balance sheet policy. Now, a lot of people build investment strategies as to whether or not the balance sheet is increasing or decreasing and so forth. Well, for you guys, rejoice, because yesterday the Fed effectively ended quantitative tightening, which is to say that they are not going to be shrinking their balance sheet, at least as much. Now, quantitative tightening was going on at a pace of about 25 billion a month for treasuries. Now it's just 5 billion, which is really small. I would say QT has virtually ended. So the Fed is, markets like that a bit. You can see the treasury market feeling a bit more supportive of that. But overall, it was a meeting that is, wasn't that impactful, because going forward, all the macro is going to come from the White House, from Congress. So the Fed is really not going to be as important as it used to be. So I think that's how we'll summarize the meeting yesterday.
Austin, so before you got wildly obsessed with stablecoins, you did used to be a rates trader. That was your world. So I'm going to tap on that world for just a little bit here before we get too deep onto the stablecoin side of things. But what's your high-level framework for how to think about macro today? Is it just, being fully focused on the fiscal side of things? What's your current perspective on monetary? How are you characterizing that?
Yeah, I think, all right, so let's zoom out a little bit from the United States, actually, which I think is a useful exercise right now. We're used to thinking in the United States of ourselves as a country that has a relatively clean fiscal situation and clear monetary policy. And historically, so if you're thinking 90s, 2000s, you would look into emerging markets to find most places that we would think were in significantly worse shape. But one of the things I've been observing from a macro perspective is lately the United States itself has started to trade more like an EM sort of exposure. And maybe the best example of this was when we cut rates in the short end of the curve and the long end of the curve went up. Right, like I remember having a long discussion with a friend of mine who traded Brazil about that exact behavior there. And the other thing I would point people towards is we now have corporates in the United States funding cheaper at the 30-year point than the federal government. Right, so let me repeat that. Corporations are less likely to go bankrupt than the federal government. Okay. What that means to me, and back to what you were saying, is that this kind of puts the Fed in a no-win position, and that's why they're very reactive. Because if you cut, you're going to control the short end and lose control of the long end. If you raise rates, you're going to crater the economy, but maybe the long end looks a little better. And so we're in a position where, quite frankly, the fiscal is leading the monetary in a way we're not used to in the United States. All of this comes down to, until people have confidence that the deficit will not be like 200% of GDP, then all of this behavior gets much more like you would expect from EM countries than the US. And that's kind of the framework I'm viewing everything through.
Yeah, Joseph, taking that mantle of this dynamic of what happened in September, where, yeah, we got, we started off with the 50 bips cut and we saw the long end sell off quite significantly. You're calling for 4 or so cuts for 2025, and to your point, the Fed's only at 2, the market's around there as well. If we were to move forward into these accelerated cuts, what do you think is the impact on the long end there in that respect? Because to what we've already been saying here is that the Fed has been burned a couple times too many, where now they're somewhat complacent and slow to react. What does that do to the market, like the fixed income market?
Well, first off, I really like Austin's idea of the EMFication of the United States, because you can kind of see that in a few ways, right? We have a rampant fiscal deficit. We have, some people perceive it to be weakening rule of law, and so, and a lot of times the fiscal authorities seem to be much more influential than the monetary authorities. Now, one other thing that's very common in EMs is you have these tremendous boom and bust cycles, whereas you have, let's say, high interest rates in an emerging market, foreign capital rushes in, harvests those higher returns, and then, one day they all rush out, and that causes the financial markets of the EM to tank. You kind of have this happening right now, right? So this past month, you have a huge amount of repatriation of foreign flows moving out of the US into places like Europe because of rearmament, maybe to China, where there's been a lot of interest in the tech sector there. So you kind of see the US financial markets tanking because foreign capital leaving, basically just what would happen in an EM boom and bust scenario. So that's definitely something we want to keep in mind as we go forward. Now, thinking about what would happen to the short end, so my base case, what would happen this year is a replay of 2018. Now, the U.S. is still, I think, has a lot of things going for it. Ultimately, it still has a reserve currency. Still, the dollar is the international currency of choice. We still have very deep and liquid capital markets and are perceived by many to be a good destination for capital. So I don't think we are fully going to change that anytime soon. But in the event that we do have a significant risk-off event like we did in 2018, now for those of you who don't remember, in 2018, the markets were probably down 20% from peak to trough, basically sold every single day into December, and there was some real panic everywhere. But at that time, the markets began to price in a lot more rate cuts because they were afraid of recession or something worse. And so I think that's going to replay right now. So if we were to have a significant correction, given that the trade policies today are much more severe than they were in 2018, we'd have a big correction in the market. I think that would still give us a flight to safety bid at the moment, or at the very least, the market would price in more rate cuts, and I think that should put downward pressure throughout the curve. I don't think it will last. I think that going forward, given all the trappings of EMification, we could see higher, longer-dated yields in the future. But for this year, I think there's still a good safety bet if we do have a big market correction like I think we have. And we were down 10%, but I don't think that's big, guys.
Are either of you guys in the camp of, so okay, we've had a 10% correction so far in equities. The cost of that was significant compared to the 50 bips bond rally that we've had so far. We've been hearing this notion that they want to get the 10-year yield down. We were joking earlier about how they're making it very explicit that is the all intents and purposes goal of the administration right now, which is quite significantly different from the last term. So there's this idea that they can see some pain and then just beautifully come underneath and catch it with a nice soft cushion, and there won't be any sort of recession. At most some sort of growth scare. So I want to ask you both, how likely do you see that scenario as occurring versus, if they're playing with fire here, how likely is it that could get too carried away?
All right, so I'll give something of an off-market opinion. I don't think recessions are necessarily a bad thing. Right, creative destruction exists for a reason. You don't want an economy where you have relatively inefficient and failing firms that just stumble along forever as zombies. Right, that's not a good way to run things. And using monetary policy, right, or fiscal, quite frankly, to immunize your markets against volatility doesn't get rid of the volatility, it just hides it. And then eventually it's going to show up all at once. See, for instance, 2008. And I would suggest that I don't think it's a good idea to be thinking about exactly when to catch this thing. I think the right thing to do is think from a first principles basis about what is good fiscal and monetary policy, period, full stop, and just do that. Consequences be damned, with the caveat that there is, of course, some level of consequences that is too severe and people start like, oh, I don't know, collapsing your government and things like that. Don't let it get that far. But the barometer should not be recession or no recession or growth scare or no growth scare. Those things are fine, right? The thing should be, are we putting the country on a long-term, like, sound set of fiscal and monetary policies that when we look back 20, 30, 40, 50 years forward, we will say laid a foundation for sustainable growth?
No, I completely agree. I mean, so a lot of things that are being done right now are very disruptive. But so the Government Accountability Office under the Biden administration gave an estimate that there could be as much as $500 billion a year in fraud in the federal government, right? So if we were to have that to be better distributed, that's a good thing. And of course, having a recession, we move some resources from where they're poorly used to where they could be better used. That's better for long-term growth, right? And looking at trade policy, so the administration wants things to be made in America. It wants to rebuild the industrial capacity of the United States. Now, that's important for security reasons, but if you look across the world, other countries that have very restrictive trade policies, like China, for example, have been able to build a very successful manufacturing economy, right? Literally lifting hundreds of millions of people out of poverty. So there is a path towards this that could be leave the United States in a much better position than it is today. I think the market is too dismissive of that, and that is definitely a possibility depending on many factors. But with the administration is staffed with smart people, so hopefully we'll get there.
So one of the major dynamics that characterizes this EMification that we keep talking about is when a country starts to issue more short duration than long duration. And that has been the theme of the past few years. We've seen the Yellen Treasury and the Biden administration heavily weight T-bill issuance. So now we're getting into this dynamic where we have a lot of the short duration that just keeps having to be, rolled and refinanced here. And then the big question of, and I think it's related to this idea of the Scott Bessent Treasury talking about trying to lower yields. So, underlying a lot of these themes is this idea of, okay, who is going to become the next great marginal buyer of duration? And the way I see it is that there's a lot of different existing levers that can be pulled, but there's two new innovative ones. And the first one, and I'm going to ask this one for you, Joseph, is this idea of, we've heard it be called the Mar-a-Lago Accord. We've heard this idea of century bonds being potentially issued to other countries in exchange for security guarantees. 100 years, zero coupon bond, that's a terrible deal for anybody, but the idea is that's just the cost of doing business. How likely is that? And then I'll come to the next lever to you, Austin, after.
So the Mar-a-Lago Accord comes from a paper written by Stephen Moran, who is now the chairman of the White House Council of Economists, also a former guest on Former Guidance. And, and in that paper, he discusses one of the solutions the U.S. could deploy to try to create demand for its debt. And that is to say, we go around the world and say, hey, we protect you. Protecting you is very, very expensive. So how about you share the burden and maybe buy some of our debt? So that, I think, is a strategy that could work for some countries, but probably not very many. If you look across the world, a lot of countries simply aren't very dependent upon the U.S. security umbrella, and I think some of them would actually say the U.S. is the greatest threat to their security. But there are countries that are highly dependent upon U.S. security. For example, Japan, always been a very good ally with the U.S., very close military ties. Maybe a country like Japan would be willing to sign up for something like that, a Mar-a-Lago Accord. But I think the amount of juice we could squeeze out of this probably isn't that much. A much better way would be the banking reforms that maybe we could talk about later on, and also another very new and ingenious solution that I guess Austin would tell us about.
Austin, tell us about stablecoins, and how has that become the next great marginal buyer of debt?
Yeah, so if we think about marginal buyers, a lot of foreign governments have been reducing their holdings of stablecoins, and the great irony of that is that the countervailing weight is that the people in those countries are increasing their holdings of U.S. treasuries through stablecoins. So, look, people greatly overcomplicate the discussion around stablecoins and also call a lot of things stablecoins that shouldn't be called stablecoins. But a properly constructed stablecoin is just a box that basically holds stuff that looks like T-bills and treasuries. Very simple. And it's just represented on a blockchain. Now, the important part of that is that there's two criteria, right, for you to get your hands on that. One is that you've got the internet, and the other one is that you have something of value to exchange for it. So like when I was at Paxos and running BUSD, the only country in the world where I was relatively certain no citizens owned our stablecoin was North Korea, because it fails that first test of people having access to the internet. Everywhere else they were using it. And when you go and look, there's actually a very significant preference still for the US dollar internationally compared to almost any other currency at the base level for people, right? It's a little bit like Churchill on democracy, where the dollar is the worst currency except for all the others. And what that means is, you know, what, Tether is probably, I think I saw the stat today, the 7th largest buyer of treasuries globally now, and growing. And so if we pass stablecoin legislation in the United States, you have larger and more sophisticated financial institutions that are able to issue these. Because look, whether you trust Tether or not, most people probably trust, I don't know, Fidelity, right? BlackRock, JP Morgan, to manage these things well. And that means, whether other countries like it or not, which is kind of an important point on its own, we can now sell treasuries directly to citizens in other countries and let them opt out of their local system and local currency into US dollars at size. There's a very significant chance that the single most important thing Congress will do over the past 10 years and next 10 years is pass the stablecoin bill. And we could be looking at this 30 years forward as, oh, well, that's the moment where they destroyed all but the G8 currencies, right? Everything else just got completely run over by this being generally available. Obviously, that is a very large source of funding for the US Treasury if we do that properly.
What changed in Congress and government? You know, they were pretty against stablecoins for a while. Was it just, you know, it was being bucketed in with all the other stuff of crypto, and there wasn't this deep-seated realization of the potential to, you know, further out US dollar hegemony? Like, explain to us, how is this track, this timeline where we are at now, where there's bipartisan support for the stablecoin legislation?
Well, so I'll start by saying I think there's been bipartisan support for stablecoin legislation in the House for a long time. Right, because if you look at people who are opposed to stablecoins versus in favor of stablecoins, the number one predictor is not political party, it's age. Right, like Richie Torres was on Unchained and talked about this and literally said the problem is the gerontocracy that we have on top of the Democratic Party. Right, because if you're 75 years old and still think it's 50-50 that PayPal is a scam, then certainly you're not going to be cool with stablecoins. All right, fine. But the House, I think, has had the votes for a long time. The change is the Senate flipping Republican because there's nobody in this country who hates changes to the financial system more than Elizabeth Warren. All right, and so when the Democrats and the specific Democrats, so this is not Democrats writ large, it's literally Elizabeth Warren and Sherrod Brown, were in charge of Senate banking, they were an absolute blocker on legislation. The fact that they are out of the way means that if they put the Genius Act to a vote today in the Senate and it could actually get to the floor now, I think there's 70-ish votes for it. And you'll notice there's only about 50 Republicans. So what does that tell you about the Democrats? Right, I think it's just the blockers being moved out of the way and the regressive party leadership on technology being pushed aside is giving the younger Democrats a chance to voice their real opinion.
Joseph, I want to ask you, with that said as a context of what's occurring on, you know, the technological side of the innovation of US dollar, you know, reserve currency hegemony, there's a lot of people that, you know, talk about this idea of like the BRICS currency coming forth, the end of the US dollar reserve currency as an entity. But in the same vein, you know, you used to be at the New York Fed, you were on the trading desk there, you were deeply involved in money markets, et cetera. And you know, over there, for those that aren't aware, but there's been a very, very significant shift in recent years over there. You know, we used to be on an unsecured standard, LIBOR, and now we're on a secured standard, SOFR. How do you think about this idea of the continuation of the US dollar hegemony? You know, because now if we're on a world where LIBOR was a global lending rate, and now SOFR is very much tied to US Treasuries. So, Like, how do you view that trend continuing, and especially, taking into consideration some of these ideas of stablecoin innovation?
Well, the president has said, BRICS, if you want to use a new currency, we're just going to tariff you or sanction you 100% so that you'll never be able to do that again. So I don't know how effective that would be, but I think what the administration would like is, although you don't necessarily have to have a strong dollar because you want to boost your manufacturing, you do want the dollar to be a reserve currency. And the way that they're trying to do this is to move away from the sanctions and towards things like tariffs. So sanctions are different from tariffs in that, let's say, back in the Russia-Ukraine war, you could just confiscate someone's assets, right? If you are sovereign or if you are foreign national, you could potentially lose everything. That's a very different risk than saying that you'd have to pay an extra 10 or 20% to use a dollar or to use the U.S. financial system. So if the U.S. were to shift away from that standard of sanctions, trying to basically take someone else's money if we don't like you, then moving away from that towards something that's kind of more of a toll, more of a tax, I think that is positive for maintaining the dollar's hegemony as a global reserve currency. Now, as you rightly note, the standard has moved from an unsecured to a secured system. The reason for that is that one of the things we learned from the great financial crisis is that unsecured can be very risky. It could have systemic risk. So when the banking system goes down, all that unsecured stuff, that's not looking too hot. You can lose everything. If we have a secured system, and it sounds like the stable coins are going to be backed by very sound collateral, so maybe they could be perceived to be secured as well, right? T-bills and other aspects. So having a secured standard is something that could further strengthens, I think, the role and assets' role as a reserve currency in widespread use.
Austin, I want to ask you, so let's get to this, macro crypto colliding moment here. We've already talked about this a couple times this week, but I'm asking you again publicly, but around that idea of SOFR and all of that is the great complex of money market funds. And now we're talking about stable coins. So, where do you see this going? Are stable coins just a digital version of money market funds? And is it going to replace everything that is existing over there or, complement it? How does this all start to fit together?
Yeah, so I guess as a starting point, stablecoins in the Genius Act are almost literally money market funds, right? If you look at the form factor, it's a bankruptcy remote vehicle inside of a specific legal form factor that can't use leverage, but can buy T-bills and do repo and reverse repo on government securities. I've just described Fidelity's government money market fund, okay? Like literally. It's a money market fund. And stablecoins are just a wrapper that gets those onto a blockchain. Now, where does this start moving things? Well, one of the trends we've seen post-2008 writ large, before we even get to blockchains, is a move away from opaque, credit risky bank deposits as something people prefer, and a move away from risky short-term commercial paper for which you don't pick up much yield. That was prime money market funds, and they've been shrinking into one of two things, which is government guaranteed money market funds, which have been growing, or the balance sheets of the largest banks, because there's this perception that if Wells Fargo fails, the government's going to bail them out. So I'm not going to be in my local community bank. I'm going to be in Wells Fargo. And by the way, both of them are paying me zero yield on my checking account, so who cares? My personal view is where these things will move is to realign sort of the framework of the financial system, and that the current modern bank is actually an incredibly dense entity that didn't really exist like 50 years ago, where your bank would be the one who held your deposits and gave you your mortgage, but like that's it. It wasn't also the biggest source of all your electronic payments and managing all of your assets and like handling all sorts of other stuff. These are incredibly dense entities, and one of the things stablecoins will allow for is the unbundling of the banking services, which is not to say the big banks will get smaller, but at least you'll have a better choice of the services that you take from them. And the other thing it's going to do is in the current system, because we tell banks only you guys can do electronic payments for the most part, okay? So like all of you are deputized. And all of the banks have decided, okay, well, we're going to offer the following deal to consumers. We pay you zero on your deposits. We're going to go lend that money to other people, often quite risky. And when that works, we make a ton of money and pay ourselves huge bonuses. And when it doesn't work, well, you're going to lose your money on the deposits. that's not fundamentally a great economic arrangement for people who want to use the system for payments, but they're stuck with it because you've only got banks. Giving another option for that is going to force banks to compete for deposits at fair prices in a way that probably moves this sort of very large and implicit subsidy that we're giving to borrowers in the current system back into the pockets of people using the system for payments. And again, if we're thinking about a country that in general has significant levels of indebtedness and trying to figure out why this sort of market shift is probably not the worst idea.
Joseph, I want to get your take on that and also characterize it around, your experience being in repo markets and money market fund. Like, we've gone from this era of, along with going from LIBOR to SOFR, is this idea of going from, this corridor system for the Fed funds rate to this modern era where we have the reverse repo protecting the lower bound, and there's still some tweaks to work on the upper bound in terms of the standing repo facility for protecting that upper bound. But do you see any major improvements that need to continue to occur in that realm, or as things are good? And do you see any, interesting solutions that come forth from digital assets such as stablecoins that might help complement some of the, whack-a-mole issues that have occurred over the last few years? Like the September 2019 repo crisis that now has mostly been fixed. But yeah, how are you thinking about all of that?
So from what I hear, the description of a stablecoin is basically it's basically like a shadow bank, right? It's like a money market fund. It's maybe a potentially more efficient form of money market fund that, depending on how the adoption is for these stable coins, could be more liquid than actual money market fund shares. Now, as you know, the Fed has had an increasingly large footprint in money markets. In the past, the Fed would try to set interest rates by controlling the amount of reserves in the financial system, but now it's very much done through administered rates. On the lower bound, it's reverse repo facility. On the upper bound, there is a standard repo facility that could potentially put some sort of a ceiling. Now, I think these two are related because when the Fed is active in the money markets, that creates greater stability. And that actually makes anyone who is in the money markets a bit safer. So if you are a stablecoin fund and your assets are in T-bills and repo, you have the Fed there basically backstopping this entire market. That makes, on the liability side, your stablecoins safer. And so I think that would be, I don't know if they intended it to be, but anything that's linked to money market space to be a safer asset because there's less volatility and an implicit backstop.
I think another important point there is you look at how money market funds are constructed post-financial crisis is you don't have leverage in them either, right? Like if you're thinking about systemic liquidity issues, right, we have a live example of this, which I think people forget. So in the NYDFS has been regulating stablecoins since 2018 and basically been using a framework very similar to what's in the Genius bill. And they had a stablecoin that was, I think at the peak, like $23.5 billion, which was BUSD, that went basically to zero in the course of 3 months when it was shut down. And what happened in markets? Nothing, right? And who lost money on that stablecoin? Nobody, right? Like you can build these things correctly to the point that the only way you're going to have a stablecoin collapse in disorderly fashion, unlike, say, banks, which actually fail way more often, is if the US Treasury itself is the problem, given the collateral, which is where the Fed providing liquidity is effective because the collateral is collateral you can provide liquidity against. We're not sticking a bunch of like really junk-rated ABS in this. We're actually using a government money market fund. And so to me, that is a fundamental restructuring, like you've been saying, of some of the building blocks here, but in a way that, knock on wood, so long as the Treasury doesn't blow itself up, is probably in favor of systemic stability.
There's actually a secret backup plan that in case the Treasury kind of hits a debt ceiling, that the Fed will still step in and backstop it. So you're good even in that case.
So you're saying instead of like an auction failing, they would step in for that?
No. So one of the potential disruptions in the Treasury market is something called the debt ceiling. So what happens is that the United States spends more money than it receives in taxes. So in order to pay its bills, it has to continually issue debt. That's why our deficit continues to grow. But what happens if we hit a debt ceiling? Then bills come due, but we can't issue more debt to finance that. In that case, so there is actually the House subpoena documents from the Federal Reserve Bank of New York, and they were gaming it out what they could do. What they could do is something called payment prioritization. So the United States, again, all this tax revenue and all this expenditures, you got to pay military, you got to pay grants and stuff like that, everywhere. What they would do, the amount of inflows from taxes is more than enough to cover principal and interest for treasuries. So they would prioritize payments to make sure that the debt holders received their interest payments, received their principal, but basically default on, say, the post office workers or someone like that. So even if we were to hit the debt ceiling, the treasury market would be okay.
All right, not political advice, but let's not try that.
Yeah, let's not touch that beast. Okay, last question for you both here is a two-pronged one, but the final two big components of this idea of macro and crypto colliding is one, this recommendation and this talk about a sovereign wealth fund for the U.S. And paired with that is also this, and I don't think there's going to be any answer here that gets people excited if it wants them to pump their bags, but the strategic Bitcoin reserve. How do you both think about those two potentialities, and what are they trying to solve, and is it even a good idea? Austin?
Yeah, fine. I'm going to get into trouble again. All right, so one, I am on record of having said in the current environment, I think the Bitcoin Strategic Reserve is an absolutely pants-on-head stupid idea. So I'll just lay that one out there. And the reason is, let me walk you through the logic, okay? We're spending too much money. And so the way we're going to solve that is by spending even more money to go buy some lottery tickets, okay? Any financial advisor would tell you, for the love of God, don't do this. I would argue a Bitcoin strategic reserve at state level might make sense. There's some logic around that. And a Bitcoin strategic reserve, if we were running a surplus, I'm not personally in favor of it, but like, fine, whatever, do what you want. But a Bitcoin strategic reserve, while our problem is we're already spending too much money, and by the way, the primary thing that's going to pump the price of Bitcoin is continuing to spend too much money. Like, you can kind of see the circularity inherent in that problem and what's going on there. How about instead of starting a reserve, we just, okay, I know this is going to be shocking, have we considered spending less money? Right, so I think this is sort of the classic, it's like the alcoholic trying not to admit they have a problem about drinking behavior. Like, we really just need to get to the core of the problem here, guys.
So I guess on the U.S. Sovereign Wealth Fund, at first blush, it sounds like a very strange proposition, right? Usually countries that have sovereign wealth funds have tremendous trade surpluses or some kind of windfall from their natural resources, like Norway, for example. They have all sorts of oil and gas. They earn a lot of hard currency that they deploy for the benefit of their citizens. But in the U.S., obviously, that's not the situation here. From what I hear from, say, Secretary Lutnick, the goal of that is to maybe capture some upside on companies that the U.S. invests in. For example, let's say that the U.S. offers tax incentives or grants to certain companies or certain sectors. Maybe in exchange for these benefits, these companies could offer the sovereign wealth fund some warrants or shares, so that maybe the U.S. is able to benefit from some of the subsidies they offer certain sectors or industries. So in that sense, that sounds like a reasonable idea. It will all come down to execution. So the administration is trying different things. I would give them the benefit of the doubt. Maybe, trying something new, we get a better outcome.
All right, so as a final point, it's too bad Mike Dudas left, because I'm about to give a rejoinder there. The other thing that I think is fun watching macro and crypto collide is how you can see like the different asset classes in crypto starting to mimic the actual behavior of asset classes in traditional finance. Right, and one that I would say to people, like back to the Bitcoin analogy, it is actually starting to behave like digital gold, which is how you can predict the thing. But I'll say my most fun analogy that I hit somebody with earlier today is one of the greatest parallels is actually between the art market and the meme coin market, because the primary purpose of both is actually still just money laundering.
I thought you were going to go, and I'm going to ask you for this analogy as well, but usually one of the big lessons for crypto is to not just keep repeating the same mistakes that the finance industry has already figured out, because I'm gonna let you finish it and make sure you touch on the French quant blowing up too.
Oh boy. All right, so Felix is picking on me for my views on stablecoins again. Yeah, crypto, like in another parallel, is just speed running the history of traditional financial products. Like I was having a conversation with somebody about Terraform Labs, and he's like, isn't it weird that we built this unique thing and it failed? And I'm like, it's not unique, right? This is a self-referential equity node. There's nothing in crypto I haven't already seen a French quant blow up, is what I said to him. But the idea here, and what I think is important to move the industry forward in a meaningful way, is that the discipline of finance is certainly not perfect, and there's a lot of dumb things that happen there. But that doesn't mean over the many hundreds of years, thousands of years that we've been doing it, we haven't learned any lessons. And trying to reinvent a car from first principles when you can just walk outside and look at a Toyota is probably a bad idea, right, in the modern world. And so the other thing that I'm actually hopeful for that we continue to have a collision on is the crypto people actually bringing technological innovation to banking at the same time the banking people can bring, like, oh, I don't know, risk management to crypto, because it would be really nice to have a system that has both instead of neither.
Well said. All right, that's all the time we have. Last panel of DAS. Hope everybody had a great time. It was a great few days. Thanks so much.
Thanks.